Hello and welcome to a discussion on how to record and report revenue earned under long-term contracts. After viewing this video, you should be able to state the reason revenue earned on long-term contracts has to follow different guidelines than other revenues. You should be able to record journal entries for the activity associated with long-term contracts, estimate and record the amount of revenue and income to report on the income statement, and determine the balance sheet amounts reported for each period work is done on the contract. Some companies provide goods or services under a contract over 1 year. Revenue recognition principles require that revenue be recognized in the period the goods are delivered and title transfers to the customer. If the revenue recognition principles were followed for long-term contracts, no revenue or expense would be reported on the income statement as work was being done. In order to report earnings that represent the activity that occurs during each period, revenue has to be estimated and reported in proportion to the cost incurred. GAAP provides two methods of accounting for revenues under long-term contracts. The percentage of completion method is used when the total contract price and total contract costs can be reasonably estimated. The completed contract method is used when the total contract price or total cost cannot be reasonably estimated. A few unique accounts are used to record the activity that occurs during the period. All costs incurred during the period for the project are recorded to an asset account called Construction in Process, or CIP. The CIP account accumulates the cost of the project that is delivered to the customer upon completion and functions similar to long-term inventory. Most contracts have milestones for when billings can occur. As these milestones are met, the company bills the customer and records accounts receivable and a liability account called billings. Notice that revenue is not recorded when the receivable is recorded. Revenue is not recognized for the amount billed. Revenue is recognized for the amount that gives the estimated earnings for the period. It is a computed amount. The actual cost incurred is also recorded as an expense. There are 4 common journal entries used to record activity that occurs when working on long-term contracts. First, the costs incurred during the period are recorded to the Construction in Process account. Second, accounts receivable is recorded along with billings when the customer is billed. Third, cash received reduces accounts receivable. And fourth, revenue and expenses and profit are recorded. The amount the customer has been billed is also considered owed to the customer. The amount in Construction in Process is the amount invested by the company in the long-term inventory. The two accounts are reported on the balance sheet. The net represents the cost of the project that has not yet been billed or that has been prepaid by the company. The net is reported on the line of the largest account. The percentage of completion method recognizes revenues and expenses, or cost of goods sold, at the end of each period. Expenses are recorded for the cost actually incurred during the period. Income earned to date is estimated and recorded to Construction in Process, or CIP. Profits increase expected future benefit and are recorded as a debit to CIP. Losses decrease expected future benefit and are recorded as a credit to CIP. Revenue is recorded for the amount that gives the estimated income for the period. Income for the period is computed on this table. The table begins with the contract price, which is compared to the actual cost incurred plus the estimated cost, to determine the total income expected to be earned on the contract. A portion of the total income is assumed to be earned up to this point in time. The portion earned is determined by the percent of total costs that have been incurred to date, referred to as the estimated percent complete. The table is cumulative, and the current period income is determined by subtracting income reported in prior periods from the total cumulative income expected at this point. This table computes the income earned, which is used to back into the revenues that are reported for the period. Let's look at an example and determine the income and record the activity under a long-term contract. Notice the information necessary to do the accounting is the contract price, cost incurred each year, the estimated cost to complete at the end of the year, billings during the year, and collections during the year. The first step is to compute the estimated income to be reported for each period using the table. In practice, you will not know the year 2 information at the end of year 1. However, all information is presented here at once. The contract price is compared to the total estimated cost to determine the total estimated income. The estimated percent complete is multiplied by the estimated income to determine the income cumulative to date on the contract. This amount is compared to amounts previously recorded to determine the amount of income to report for the period. In year 1, nothing has been previously reported. In year 2, the amount previously reported is subtracted to get the amount to report for year 2. The first entry records cost incurred during the period to the construction in process account. This account functions like a long-term inventory account. However, it will not become cost of goods sold like a typical inventory account. The total in the construction in process account will be offset against the billings account when the contract is complete. The second entry records billings to the customer. The customer owes the company for work billed at this point, and the company owes the customer the work that was billed up to this point. The third entry records cash collected from the customer after billing the customer. This is only an exchange of one asset for another. The last entry records the revenue earned, cost incurred, and the estimated income earned in the current year. Construction expense is recorded for the same amount of cost incurred during the current period. Construction in process is recorded for the amount computed on the table. Income is recorded as a debit, an increase in assets, and losses are recorded as a credit, a decrease to an asset. Construction revenue is the amount that it takes to balance the journal entry. Construction revenue less the construction expense gives the estimated gross profit determined by the table. All amounts in the entry are for the current year only. The debits and credits recorded for the second year are the same as the first year. Current year costs are recorded to construction in process. Current year billings are recorded, and current year collections from the customer are recorded. Notice that all journal entries are made for the current year amount only. The last entry records the revenue earned, cost incurred, and the estimated income earned in the current year. Construction expense is recorded for the amount of cost incurred during the period. Construction in process is recorded for the amount computed on the table. Income is a debit, and losses are a credit. Construction revenue is the amount that it takes to balance the journal entry. When the contract is completed and the project is provided to the customer, the billings account and the construction in process account are offset and removed. This entry is only made at the end of the contract. The total cumulative amount recorded to construction in process must be equal to the total contract price. Both costs and profits are recorded to the construction in process account. The total recorded to the billings account must be equal to the total contract price. And the total profit or loss recorded for all years must equal to the total profit or loss known at completion. Accounts receivable, construction in process, and billings are balance sheet accounts. The balance in the construction in process account and the balance in the billings account are offset and reported net on the balance sheet. In year 1, the construction in process is greater than billings, and the net is reported as the asset CIP. The income statement reports the revenue and expense accounts and the resulting gross profit. Nothing is reported on the balance sheet at the end of year 2 because the project has been delivered to the customer and nothing is owned or owed. According to the principle of conservatism, losses must be reported in the period the company becomes aware of the loss. As such, all anticipated losses under long-term contracts must be reported in the period the loss is first expected. Losses must be recognized in the period the loss is initially expected, even though the loss may occur over several future periods or not until the end of the contract. In this example, a loss of $400,000 is expected by the end of the first year of the contract. Ignore year 2 information for now because it is unknown at the end of year 1. The percent complete is not computed, and the company must recognize 100% of the loss in the year the loss is first expected, which is year 1. By the end of the contract, at the end of the second year, the actual loss is $100,000 less than the originally expected loss. The increase of $100,000 is recorded in the second year to get the total reported on the contract to be the actual $300,000 loss. 100% of the expected loss of $400,000 is recorded in year 1. Losses are recorded with a credit to construction in process because they reduce the value of the expected benefit to the company. Construction expense is recorded for the current year cost, and revenue is recorded for the amount that gives the estimated income. In year 2, $100,000 income is reported. Construction expense is recorded for the amount of cost incurred in year 2, and construction revenue is recorded for the difference. The income statement reports activity for year 1 and for year 2. The total recorded to the construction in process account is the cumulative $300,000 loss incurred on the contract. The total for both years recorded to revenue is the $10 million total contract price. 100% of an estimated loss is recorded in the first year when the loss is first expected. The loss is adjusted in the second year when the year the contract is completed. When the contract revenue is not known or the total expected cost cannot be reliably estimated, estimated income cannot be computed. As such, revenues and estimated income for each period cannot be computed. The percent of completion method cannot be used. In this situation, the completed contract method is used. This method reports revenue just as it is named, 100% at the completion of the contract. This method records the activity that occurs during the period using the same debits and credits and amounts as the percentage of completion method for the first 3 entries. Costs actually incurred, billings and collections are known and recorded during the period as they occur. The only difference between the percentage of completion method and the completed contract method is when construction expense, construction revenue, and gross profit is recorded. Nothing is recorded and reported on the income statement until the contract is completed. The 4th journal entry is only made at the end of the contract. After viewing this video, you should be able to state the reason revenue earned under long-term contracts follows different guidelines, and record journal entries for the activity associated with long-term contracts. You should be able to estimate and record the amount of revenue and income reported for each period work is done on the contract, and determine the balance sheet amounts reported for each period of the contract. Please go to StudyMyAccounting.com and work through practices you learn for examples of accounting procedures followed to record each of the concepts discussed in this video. Work the practice test. Please write out your answers and check your understanding to the answers provided. Thank you for being prepared for class. It is much appreciated. I'm done. Oh yeah.